When you fill up your tank right now, you are bleeding cash. But that exact financial pain is driving massive gains on Wall Street. The immediate catalyst for this price shock is the conflict between the US, Israel, and Iran. The fighting has severely disrupted global supply lines. Specifically, the conflict has effectively shut down the Strait of Hormuz. This map shows the Strait of Hormuz. It is a geographic choke point that normally handles 20% of the entire world's oil and liquid natural gas supplies. When a physical bottleneck of that scale suddenly closes, the immediate result is a severe spike in consumer inflation. With that supply vacuum taking hold, global oil prices have climbed roughly 40% since the conflict began. This chart tracks Brent crude. Before the conflict, the price sat calmly at a flat baseline of $73 a barrel. Once the war started, prices swung wildly, peaking above $120 before settling back down near $101. While retail consumers absorb the impact of these surging costs, major energy corporations are stepping in to capture the massive financial upside. In the global commodities market, the exact dynamic creating your inflation is generating their profit. This vertical bar chart highlights Shell's first quarter adjusted earnings. They just posted $6.92 billion in pure profit. That number easily beats the analyst expectations of $6.1 billion and heavily outperforms the $5.58 billion made during the exact same period last year. But there is a contradiction hidden in these numbers. Shell achieved these record earnings while their actual physical oil and gas output dropped by 4%. That decline in production is a direct consequence of the Middle Eastern conflict, which damaged their Qatari Pearl gas plant. How does an energy giant print almost $7 billion in a single quarter while physically producing less energy? Today's supermajors function as highly leveraged financial trading engines that happen to move physical resources. This diagram illustrates a commodities trading spread. When prices swing violently, the gap between the buying and selling price dramatically widens. Shell's trading desk exploited this volatility. They captured those larger margins, easily offsetting their physical production loss. Shell is immediately deploying this windfall offensively, executing a $16.4 billion deal to buy the Canadian energy company ARC Resources. By acquiring ARC Resources, Shell locks down decades of low-cost, high-quality shale production safely outside the volatile Middle Eastern conflict zones. They are effectively taking their wartime trading profits and buying permanent peacetime assets. To navigate these markets, you have to separate your frustration at the gas pump from your strategy as an investor. Update your blackout ledger by tuning out the terrifying geopolitical headlines and focusing purely on the raw corporate data. This brings us to portfolio hedging, a specific financial defense mechanism against global supply shocks. Holding equity in these energy supermajors acts as a direct financial shield against the unavoidable expenses you face in the real world. A properly hedged portfolio catches the upside of inflation instead of just suffering its consequences. You have a choice. You can remain the consumer absorbing these elevated gas prices, or you can become the investor capturing the supplier's margins. If you found value in this briefing, subscribe to the channel. Let us know in the comments. Are you holding energy stocks to offset your costs, or are you just footing the bill at the pump? Objective data and structural strategy will always beat emotional panic in the market.